Hello, this is Japanese Economic Review Channel. Today we analyze the Q1 2026 SME Business Conditions Survey. The main themes are a dual economy and a structural squeeze. Despite some macro-level tailwinds, the overall sentiment DI fell to -17.6. SMEs are facing critical challenges with input prices staying high at 66.5 and severe labor shortages reaching -23.2. Let's explore how these factors are reshaping the Japanese business landscape. The business conditions DI stands at -17.6, marking the third consecutive quarter of decline. Although the drop is a minor 0.1 points, it signals persistent friction in the domestic economy. While large corporations might be thriving, SMEs remain trapped in a structural slump. The gap between macroeconomic recovery and SME reality has never been clearer, requiring a deeper look into sector-specific trends. We are seeing a distinct dual economy. Manufacturing is showing a fragile recovery, with its DI improving to -15.9, driven by robust external demand, aerospace, and automotive sectors. Conversely, non-manufacturing faces a domestic slump, with its DI dropping to -18.2. Stagnant consumption and unabsorbable cost inflation are crushing these domestic-focused businesses. Looking closer, retail and services act as anchors dragging down the economy. Retail DI plummeted to -26.5, and chemicals dropped sharply by 14.1 points to -23.6. In contrast, machinery and transport equipment show resilience. This underscores that reliance on domestic consumer spending is increasingly risky, while specialized B2B manufacturing thrives. A critical issue is profitless volume. The sales DI is at -11.7, meaning revenue is somewhat stabilizing, but the profit DI has plunged to -22.5. This massive gap reveals severe margin compression. SMEs are moving volume, but structural costs are entirely eating away the returns. Top-line growth alone is no longer sufficient. Cost structures must be overhauled. This chart maps the dual-threat crisis. Non-manufacturing sectors are squeezed by high costs and capacity limits. Construction is particularly paralyzed by extreme labor shortages with a -40.4 DI, while retail is choked by soaring input prices. Services face a combination of both. Without addressing these dual bottlenecks, simply stimulating demand will only worsen profitability. The first major headwind is unyielding input prices. The input price DI remains blisteringly high at 66.5. A food manufacturer noted that despite fair business, profits are heavily squeezed by soaring raw material, gas, and personnel costs. Domestic stagnation prevents SMEs from passing these costs onto end consumers, trapping them in a conceptual margin squeeze. The second headwind is a critical talent drain. The labor shortage DI sits at -23.2. It's a structural attrition loop. Lower profits mean SMEs cannot match corporate wage hikes, leading to an exodus of talent to larger enterprises. Combined with an aging workforce, this creates operational bottlenecks. Employee retention is now an existential challenge. Voices from the ground confirm these data points. A machinery maker reports strong external tailwinds in aerospace and semiconductors. Conversely, a lodging business faced a consumer squeeze due to cold weather and lost inbound demand. Meanwhile, a personal services firm highlights the talent barrier, shifting to equipment leasing because securing staff is impossible. Economic pain is also unevenly distributed geographically. Regions highly dependent on domestic tourism and local consumption, like Hokkaido -22.6 and Tohoku -26.4, are experiencing severe contractions. In contrast, industrial hubs like Kanto -13.9 show relative stabilization. Policymakers must recognize that a one-size-fits-all approach will fail. Finally, the strategic implications. First, SMEs are in an inflation trap, acting as shock absorbers for the broader economy. Second, there is a labor capex imperative. SMEs must aggressively invest in IT and automation to survive the talent drain. Broad SME indices are no longer useful. We must differentiate between export-integrated manufacturing and isolated domestic services. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.